Hello everyone and to our loyal subscribers. Here are 3 important takeaways from the income statement in the interpretation of the financial statement by David Clark and Mary Buffett. Thank you. Lesson number 1, Uniqueness. The realm of business is a very competitive world where companies need a strong competitive advantage to survive. This is what Mr. Warren Buffett looks for when he decided to put his capital to work. He built his fortune by investing in those companies that thrive and dominate their industry. There are 3 key points on how we can spot such a company. 1. The company is selling a unique product. 2. The company is selling a unique service that is in high demand. 3. The company has the lowest cost in the product or service that is consistently needed by the public. Especially when the company has the consumer's mind. For example, if you want to paint your room, where do you think to go to buy the paint? Most people would pop in their head the name Home Depot. Whichever company that pops in your head is probably the one that has some sort of a competitive advantage over its competition and possess the consumer's mind. The favorite competitive advantage companies to invest in are companies that are selling unique services. They do not have to spend much on research and development to be top-notch in the industry. Such unique companies selling special services have huge profit margins because their expenses to keep the service afloat are very low. A good example would be H&R Block tax services according to this book. To sum up, lesson number 1 finds a company that has a competitive advantage by being a seller of a unique product or a seller that is selling a unique service. A company that is providing the cheapest cost in services or products which is consistently in high demand will have a huge advantage over their competition that is more costly. Please remember, as Mr. Lynch once said, know what you own and know why you own it. Are you currently owning a company with a competitive advantage, and does that company possess the consumer's mind? If you do, please share it with us in the comment below. Thank you. Lesson number 2. Consistency is king. The 4 consistency for a competitive advantage. 1. Does the company have a consistently high gross margin? According to a Google search, a good gross margin would be 20% or more. However, please keep in mind that industry varies from one another. 2. Does the company have little or no debt? A good ratio of this is anything less than 0.5 debt to equity. 3. The company does not spend heavily on research and development. The rule of thumb is none is best or the lowest among their industry. 4. Earnings increase consistently. The competitive advantage company should have a consistent earnings increase of 15% a year. A quick way to look at this is by taking the EPS divided by the current price. For example, if the EPS is $1 and the current price is $10, the earning is at 10%. However, we want a 15% increase year over year when looking at a company with a strong competitive advantage. Please note that a crooked company can manipulate their EPS through share buyback even when they are not making any money. A quick way to spot this is by looking at their share buyback and comparing it with their earnings, also referred to as net income. If the earnings or net income is not growing or decreasing and the company is still buying back their share, this is a huge red flag. To sum up lesson number 2, consistency is king in the world of investing. The 4 consistency mentioned can tell if the company has a competitive advantage over their competitors or not.
Before we move on to lesson number 3, what should we look at in the income statement? Please, if you like what you are seeing so far, may you kindly click that like button below and kindly subscribe to our channel. This will really help us a lot. Without your love and support, we won't be able to make it. We truly owe it all to you. Thank you so much in advance for your kindness.
Lesson number 3. What should we look at in the income statement? 1. We should look at the cost of goods sold, also known as COGS. Compare it with their competition. The lower this cost, the better it is. Of course, the net earning of our company must be par or higher than the competition, while the cost of goods sold is lower. Is a win-win situation for our company of interest. This could mean that our company of interest is more cost efficient in bringing their goods to the market than their competitors. 2. Gross profit margin. Anything 40% or more can be a good sign that the company has a good competitive advantage in its industry. Anything lower than 30% usually means that the industry is very competitive or the company is not in a strong position within such an industry. 3. Under operating expense. As you can see, there is a tab named Selling General and Administrative, also known as SG&A. Make sure this expense is consistent and does not spike too much. Be careful with companies that vary too much in SG&A year over year. For example, this company SG&A shows us a huge red flag. Their SG&A is almost 300% more than their revenue, and look at how it spikes or dips year over year. The rule of thumb for SG&A is 30% or less compared to their revenue is fantastic, but sometimes great companies can have a range of up to 80%. Make sure is not 100% or more as in the example above. 4. Again, under operating expense, there will be tab Research and Development, also known as R&D. A company with no R&D is always a better choice than a company that does, because with R&D expenses it could lead to more expenses like selling general and administrative expenses. Take two companies for an example. Company A is a drug manufacturing company that need research and development to make a new drug. After the new drug is formed or is ready for the market, they have to spend even more money on SG&A expense in order to advertise this new drug. Now let us take Company B, like Coca-Cola, which barely has any R&D costs. The only cost that Coca-Cola incurred is SG&A for advertising and marketing. At the end of the day, the less cost a company has, then the more money it can put in its pocket. As investors or partners of the company in a long run, we can also benefit from their cost saving through dividends or share buyback. 5. Depreciation is very important since the company needs their equipment or tools to produce its products. Therefore, depreciation should be added to the expense year over year. We all know how Mr. Munger feels about earning before interest, taxes, depreciation, and amortization, also known as EBITDA. Mr. Munger said such earnings are like cow manure. Another word for EBITDA is BS earning. Please remember, don't discard depreciation when looking at the company expenses. For competitive advantage companies, depreciation should be ranging from 5 to 10% a year, taking away from the gross profit. 6. Gain or loss is not a reoccurring event, so any of this number that is reflected in the bottom line should be removed to reflect the real number of the company earnings. For example, sale of property or sale of any assets of the company. If the sale reflects a gain or loss for that year, it shouldn't affect the business as a whole, and it shouldn't reflect the business for the years to come. Therefore, we should not take this number into consideration if there is any under this tab. 7. Income before tax is what Mr. Warren used to determine the earnings power of the company, not after tax, because tax can vary from time to time, but the income before tax should reflect all companies the same way. 8. Net earnings or net income. When looking at this number on the income statement, make sure is an upward trend. As we mentioned earlier, be careful when looking at EPS as an upward trend. Double check if their net earnings are reflected with the upward trend of the EPS. An example of a competitive advantage company's net earnings compared with its peers. Let us take two companies, Company A and Company B. Company A net earning is $2 million from a revenue of $10 million. This gives us the total earnings, or the bottom line profit, is 20%. 2 divided 10, that will give us 20% as mentioned. Now let us look at Company B. Revenue is $100 million and they are only netting $5 million at the end of the year. Even though the company is generating more revenue than Company A, but its net earning percentage is a lot lower. They are netting only 5% compared with Company A at 20%. As investors, we would rather pick Company A than Company B. Any company that has a net earning of 20% or more is usually the company with a competitive advantage.
Thank you so much for making it this far. Please join our newsletters. We promise no spam, only to update you when new summaries are available. We swear by the moon and the stars in the sky. We hope to see you in the next summary. Thank you so much again, you are awesome.